Let's start things off. We are here for the fourth and final installment in our Keeping Your Seat at the Table series. My name is Charlie Bathgate. I'm your host for this evening, or what is it? Not this evening, this afternoon, I suppose. And you're probably not going to hear that much from me today. If I do my job right, I'm just going to be prompting this man to speak, Ron Friedman, who is the founder of Trading the Post and a partner with us here over at St. Lucie and Wall Street Jesus. Ron, say hello.
Hello.
So yeah, we are here. This series has been a great series so far. Thanks to everybody who has been joining live and especially watching the episodes when we put them up. We've gotten a lot of really good feedback. It seems like it's been having an impact in a pretty crazy market environment, which is the goal, right? I mean, as I'm recording this for everybody watching this in the future. It's October 31st, 2022. We are just closing out, Q4 or going into the meat of Q4, I suppose, of probably the most insane year of trading that anybody has ever really experienced on a sustained basis than anybody's ever seen. We were just talking before we went live that Facebook from its top has lost an entire Berkshire Hathaway. Amazon is, just as we're recording this, down 20% from where it was at just Tuesday of last week. And it's not just that things are down, obviously, and that there's been a, endless speculation about a recession or anything like that. It's been the difficulty of trading these markets, the difficulty of the moves, the violence of some of these moves. It's been a situation where even really experienced, very good traders who've seen all sorts of different market environments have said these are the hardest markets we've ever had to trade. So that's one of the reasons why we launched this series, the Keeping Your Seat at the Table series. If you haven't seen the previous episodes, definitely invite you to go to our YouTube channel at St. Lucie and check those out, because there's some really great stuff in there. And the other reason why we're doing this series is because it is a lead up to the launch of the Trading the Post educational experience and package. If you go to tradingthepost.com, you can check out the details for that and sign up. What that gives you, just real quick, is access to Ron Friedman's course, where he teaches you what he does, all of the skill sets that he has, all the ways that he approaches options trading. He teaches it to you from scalping to swing trading to longer term trading. It's the whole goal is to make sure that you have the tools in your toolkit to fit your trading to whatever the market is throwing at you, and not the reverse. So you get access to his course where he teaches you what to do. You get 3 months of access to his chat rooms and our proprietary platform, which makes it easier than ever to focus on what you want and block out all the noise. So if you just want to see what Raj is doing, you can do that. If you want coaching from him in the rooms, you can do that. If you want to see what other people in the Trading the Post community are trading and talking about, you can see that too. There's live trading sessions with Raj, so that means you're going to be seeing his screen, hearing his voice as he takes on the markets live in front of you. There's really no replacing that. And we offer a money back guarantee on this. So at the end of your experience, those 3 months in the room, if you feel like your trading has improved, we refund you, no questions asked. That's the degree of confidence that us here at St. Lucie and Wall Street Jesus have in Ranch and what our team has built behind him. So you can save $250 on that experience up until tomorrow night, so November 1st, by using coupon code TTP save 250. Save $250 off the course in that package. So go to tradingthepost.com to check out more on that.
Awesome.
All right.
Yeah, and also Wednesday for the FOMC, we're gonna trade live, and we'll open up the trading room. So if you want to come by and take a look and see what we're doing, come by on Wednesday and see how we go about it. I mean, I have no idea what we'll get. I'll obviously look for some short-term scalp trades, but it could be an opportunity for something longer term. We'll have to wait and see. But if you want to come by and see what we're all about, that's a nice opportunity to attend and do it.
Yeah, definitely check that out. Keep your eyes on the Trading the Post Twitter, the St. Lucie Twitter. We'll have links going out for that. So we were laughing before we came on. We boldly named this episode The Holy Grail of Trading, minimizing losses while capturing upside exposure. And we were just laughing that it's funny what you come up with when you're jacked up on caffeine and possibilities. And then, a month later it rolls around and you got to back up what you've said. But I think we can do that, because that is a theme of what we've been talking about, Ron, for this whole series, is just how you position yourself, right? I mean, you have done an incredible job of doing it yourself, but also, helping the people in your community do it, to, make that money on a weekly basis, whether it's scalping or collecting premium or whatever it is that is advantageous to do at the moment. And then positioning yourself so that when a serious move happens, when the right move happens, you can capture that upside and still have your risk managed, right? And so what we were hoping to do today, is just go through a bunch of examples of trades from, from this year, and maybe even reaching back further, and talk about that. So Ron, where do you think, what's a good place to start? We talked about the NVIDIA and Netflix trades. We can certainly go back to those. We're going to share Ron's just going to share a screen here and put up some examples. But when I talk about that, Ron, what comes to mind first? What are you thinking?
Well, the first thing is that we should let everybody know is that there is no fucking holy grail.
What?
There is no holy
grail. What are you talking about? What are we doing here then? You're killing me.
So I mean, you know how it is. We're gonna give you the tools that you need, but I wish there was a holy grail. I really do. Because
there's no guarantees.
I'd be landing my helicopter on the back of the yacht, and Mick Jagger would be getting me a drink, right?
There we go. There we go.
But as far as breaking down a trade, do you want to take a stab at breaking something down so people can see, what we did, how we approached something. We've recently traded. We had a nice trade. Well, it wasn't a nice trade. We had a trade that was managed well on Google. We had a nice trade on NVIDIA and on Netflix. We're currently in a nice Iron Condor on Boeing. We had a couple of trades over the weekend that, when we got in this morning, weren't quite perfect. JPM and SPY, those were positions that went over the weekend. And then we had some members take some stuff short at the end of the day on Friday. So some of our members took Apple short, which was a great trade. Some of our members took SPY short. And you come rolling in on Monday morning, just from a probability standpoint of where things were, and they all did really well. So, you tell me what you want to take a look at, or if anybody else out there wants me to break something down that we've traded recently, so you can see our process. I'm happy to do it.
Let's start with that Netflix. I think that's a real good example of this, because it's a position that you've managed and adjusted, over time, and really captured a lot of upside on, but then definitely going into some of those other ones we can do.
Okay. So do you want me to share my screen?
Let's do it. Yeah.
I think it's helpful for people to see the charts, right?
Yes.
So let's do, is that right? Okay. By the way, I don't know if anybody had a chance to listen to this interview. What I think is interesting in this interview is that these guys repeat a theme: risk management and don't give up. I think it's super important.
Yeah.
So if you haven't had a chance, check it out.
Plus, I mean, that thumbnail is just incredible. I mean, my God, Lucci.
Millionaire trader.
Smile on his face. Jesus.
All right. So let's take a look at Netflix. Netflix has a little bit of a history for us. The history being that it's, for 10 years or more, the stock has just been a beast, right? Like it's made a lot of people a lot of money. This is a look at a daily chart. And what we like to use are, just to fill it in, we use candlesticks. And I don't mean we study or use candlestick patterns. I just mean we use candlesticks to mark where, the stock is at, red being it closed at the low, green being it closed at the high of whatever that candle is. We use some technical analysis in how we look at opportunities. And Netflix was one of those opportunities where we didn't get this trade right, but because of how we trade, we did ridiculously well. So back in how long ago was this now? This was January of this year. So you had an earnings announcement where Netflix missed and had a massive gap down. What I look for is for a stock to start trading sideways. And I want to see if I can catch it sideways to see if there's going to be opportunity for it to have a long-term move back up. So the anatomy, or the beginning of this trade, was seeing that, hey, it's trading sideways and we're coming into an area where we have some technical reasons to be interested in taking a look at it. So for example, the 8 exponential moving average crossing over the 21-day exponential moving average can signal a change in direction. This little blue line that we have here is the 50-day simple moving average. It's a little bit closer. And you can see where this stuff starts to show up, right? So this is giving us a little bit of what we're looking for is a clue as to, hey, can we find a change in direction? Has the worst of the news and all of the rest of that stuff been beaten out of the stock? So we look at taking a leap in this situation. And so a leap is a long-term option that goes out. We like to find 9 to 12 months, ideally 12 months, because if we have spotted change in direction, we're able to ride it. So what did we do? We bought some leaps. We had some nice movement upwards that never really followed through. So one of the things that we do is we write options against our leaps. So in this scenario, when a major moving average like the 50 and the combination of the other exponential moving averages start to work together or don't work, or they fail, we start to look for reasons to either protect or to start collecting premium against our long positions. It does a couple of things. Number one is it allows us to just start stockpiling cash, which allows you to pay down your position. In this type of a scenario, we're only long a quarter of a position. We're not long an entire position because it's just too much capital to put at risk when things are still uncertain. In this scenario, we got to earnings and we put on protection against our long-term position. The very fortunate outcome, and I think at the time, I would have to go back and look at the time, the forecast or what the options market was pricing in and projecting was that Netflix could have a, I think it was a 12 or a 15-point move. Maybe it was 30. I don't recall exactly, to either the upside or the downside. So one of the things that I like to do when you're in a long-term position is just buy short-term protection. If I'm wrong, the short-term protection simply goes out worthless. And what offsets that loss is, well, if the stock starts moving back up and my leap is already deep in the money, I'm going to make the money back on whatever protection I bought very quickly. So that's the idea behind it. So, what happened to us was we went to bed and, the stock was at 332 and we woke up and the stock opened all the way down here. Now the upside, exactly, the upside to how we protect these types of positions is that this gap down far outweighed any expectation that I had of a move to the upside in Netflix. So all I was doing was protecting. So some people would say, oh, you got lucky. The point is we bought insurance on our Porsche 911 Turbo, knowing that it was raining out and that our 16-year-old who was going to prom and likely had been drinking and maybe smoking some weed was going out in that car. That's what that insurance was for.
Yeah, I mean, you're basically saying you wouldn't, if someone said, oh, you got lucky, you wouldn't argue with them and say, no, I didn't. You would say, yeah, I fucking did. That was the point. I love to get lucky and make money when I'm lucky.
That is the point. So in this instance, what happened was, well, we shut the trade down. We walked away. We were like, all right, we won. We didn't expect to win. We won in a big way. It was because of calamity. So we walked away from this trade for a long time. More recently, what happened was they had earnings back in July, and it caught my attention. Why? Because it was trading sideways. One of the things that I really like about a sideways moving stock is that we can use a strategy called an iron condor. So when I noticed Netflix moving sideways, my thought was, well, Netflix just moves around so much. It has these violent moves both up and down, but in between its earnings periods, I mean, if you just kind of take a look at a chart, your eye notices that it has a tendency just to move sideways. So the way to kind of take advantage of that is to use a strategy called the Iron Condor, which basically means I'm collecting premium on both sides of a trade. So for example, you can see that Netflix in this little spot right here is trading in a channel, or, you know, not a predictable range, but a range nonetheless. So you are taking some probability to say, hey, it's having a hard time getting above this 251 area. And it's also having a good support area here at this 215, right? So in between, can I write option contracts? Can I write calls above 250, 255? Can I write calls below 210, 215? And how much am I going to get paid for that, knowing that there's going to come a time when Netflix likely will find a change in direction. So we traded this sideways at Iron Condors. We traded this for about 6 weeks. And then we got to earnings. And by the way, during this 6-week run, we collected on Netflix the entire time. We very rarely had an instance where we were shaken out of the trade because we had written areas that were far enough away from the top of these channels where if they had broken and we had some kind of the market moving in one particular direction, or some kind of news propelling it, et cetera, we have a technique which we refer to as morphing, and what we're looking to do is be in Iron Condors and catch a move in direction. So the unfortunate part to this trade is you had earnings, and true to form, look at what happens. You get 6 weeks of trading sideways. They start to, when I say they, I mean the market or market makers, traders. It's a slick game that we play. And what happens? They sold it off going into the earnings, and then what happens? They start buying it back up again. If you're just the every average day trader looking at this and you're thinking, man, these guys, these whoever's trading it and getting long calls is just, getting lucky on these moves. It's like, well, you look at that. I don't want to be in a trade in front of a catalyst event, only from the standpoint of I really have no idea what's going to happen. I mean, who knows? I mean, Reed Hastings could get on that call and say something even after great numbers that concerns investors. And if that happens, what happens, it could have been like, oh, okay, this would have opened up at a certain area, but if he said something funny, it could have been a great result, but then the stock opens way lower. It's a very unknown type of game. But what the condors allow us to do is collect, and when and if it does change direction, we can catch direction. So a lot of traders use condors simply from the standpoint of, I only want something sideways. I only want to collect on it. We're aggressive with our condors. We seek trades that are trading sideways and to seek areas where we can catch direction. If we can catch direction, you can have a 50, a 30, a 50-point move on a stock like a Netflix or like a Tesla, et cetera. Conditions need to be right, but that's what happens. So we traded this for 6 weeks. We had one or two inside this range, and it may have been towards the end, towards the earnings, where the range we were looking at trading didn't exactly break, but because these trades happened later in the week and our condors had decayed so much, what we were able to do is just add to our long leg on, I think it was over on this side. And, all of a sudden you have a trade where you made 60 or 70% on the trade. And then all of a sudden, because you make one adjustment, now the gain on that trade goes from 60, 70% to 200, 300%. So it's just a matter of piecing it together. Do you know what you're looking at? How long have you been there? Do you, for this 6-week period, in order for us to be able to make that, we earned the right enough money to be able to take a long shot if we wanted to. We didn't just come fumbling into it and say, we're just going to jump in and take a stab at something breaking out higher, right? We intelligently managed our trade for a period of 6 weeks. We just continued to be happy with stacking trades. We weren't going for the kill shot. We were just stack, 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 stack. And then when you finally get to the point to where everybody and their brother, even Lucci, was just like, I want to try and catch that Netflix. This is how you get to the point to where you can catch a directional move. This is not just, I need to be in the right place at the right time. I don't know when the right place and the right time is going to be. A catalyst event like earnings is likely, but how are you gonna sit there and grab it overnight? It's a coin toss, but we just built up to it so that we could take the coin toss if we wanted to, and if we didn't, we wait for the next day, and when we catch direction.
I think what you just said is huge, and it's such a paradigm shift for people when it comes to how they approach trading. I don't know when the next big directional move is going to happen.
No idea.
I just want to put myself in a position to capitalize on it when it happens. And
Correct.
There's so many people who spend their days trying to time things perfectly of when that move is happening. And it's just
I can't do it. I don't know
how's
how
that
to
working
do
out
it.
for you. It's extreme. I mean, even someone like Lucci, who is reading tape, he's a freak of nature, 1 in 10,000, 1 in 100,000 kind of trader who can literally put his finger on the pulse of a name. It's even hard for someone like him to do it, and he's got 30.
Well, he did miss this trade. He did miss the move in this trade,
right?
And
right.
It's only going to happen if you're paying attention and you find a way to participate other than just buying a lottery ticket, because that's just a recipe for disaster.
Well, I want to go through some of the other trade examples of when this worked, but part of what the series is about is managing your losses, right? So what about a time, a trade recently that you guys took on and traded in the post that didn't work? Can we go into that, and can we look at like the risk management side of things and how that showcases how protect the downside?
Yeah, so this JP Morgan was brought up by one of our members on Friday, and what I liked about it is that this was only from what I like to do is I like to look for places where I can find probability, or how do you know where a trade is starting to reach either being tired or an area of resistance, or how do I know that that's a good spot? Well, I don't know. I don't know exactly. I can look for areas and for spots. JP Morgan was a nice example last week, where this red line is the 200-day moving average, simple moving average. The reason that it's important is not because it's important to me, but it's because it's important to institutions and institutional investors. A lot of times what happens is you'll get to an area like the 200-day moving average, and what will happen is the stock will either find resistance, or sometimes it will find and use this area as a catalyst to propel it higher. So one of our members said, hey, JP Morgan on the 200, I'm looking at it. I'm looking at the broad market. The broad market is in a downtrend. We're bouncing over the last few days. JP Morgan has had this little run through some technical areas. A lot of times when you reach this area or these areas, it can get fatigued. Just the trading can get fatigued. It can catch a lot of traders who are chasing the move. So we took this on Friday, as maybe it was Thursday. We may have been here. I don't remember. One of these 2 days, we took a short position. We bought puts looking for JP Morgan to fail at the 200-day moving average. That was the only thesis behind the trade. It wasn't, oh, Jamie Dimon's a bad guy, or, we think JP Morgan is, a shitty bank, or it wasn't any of those.
No Nancy Pelosi factor in this one. No,
too soon.
Cool. Yeah.
And it was nothing more than, hey, we've got a technical area. Let's see if we can catch a trade. So we took it over the weekend. We came in this morning. It wasn't giving way. So instead of hanging in the trade, I cut it. Why? Because it didn't give me what I was looking for. What I was looking for was, okay, it's at resistance and now it fades. Well, what was I looking at to fade to? Well, the 8-day EMA, exponential moving average, created a nice target. What else were we looking for? I use a tool called a Fibonacci retracement. So I'm also looking for, can I catch an area for a target? And that's it. It's nothing more than just breaking out the tape measure and seeing what has potential. So if this would have been the right spot, and let me adjust this to where my expectations were last week. I was there. So my expectations, my thoughts for where can I profit on this? I was looking for this little area right here, the 8-day EMA. I was also looking for this area, 120. So if I've got, in a, let's say a small account, you've got a 10 lot, that's you're putting like $3,000 at risk. And if you get a move from this area down to here, you're looking at a, $2,500 or so trade. If you get down to this area, which would have been the next logical target for me, if it was actually going to break down and retrace, now you're looking at like probably a $5,500 or $6,000 trade in a matter of, let's say, 3 or 4 days, which to me, from a risk reward standpoint, is well worth it. But if I guessed anywhere else in between other than looking for a landmark, it simply would have just been without any type of thought or probability. At least here, I have some probability on my side, and I know if it keeps going, I can cut this for a small loss. And I think I cut this for like a $300 loss on a 10 lot, which to me is perfectly acceptable. It would have been fine if, if I had bandwidth or if I wanted to stay in the trade longer, it's fine. But it didn't give me what I was looking for. So I just go ahead and say, okay, I don't have it right. I take my loss, I wait. And if it starts breaking down, I already know that I'm in a spot technically where I can probably trade it again. And these little yellow dashed lines are alerts. And I don't need to pay attention to this now until and unless these areas start to give up. If these areas that are dashed give up, I'll get an alert. I'll come back in and I'll see if it makes sense for me to catch that trade again. But in the meantime, I don't want to sit here and take $1,000 loss, a $2,000 loss. I'm simply putting on an exploratory position to see if I'm in the right spot. And can I go from a 10 lot to a 50 lot or a 100 lot and put some more risk on and catch a 5-point move, a 10-point move? Then I'm in a spot where I'm using probability, and I'm in a spot where I can manage a small loss, and I can put myself in a spot where I can have a nice return if it plays out the way I want it to play out.
Yeah. Yeah. And I think to fill in some gaps, Ronch he has multiple accounts that he trades with. We've talked about this on other webinars. And one of the things that he's doing this now that he just started is he opened up a smaller account, which is, the examples that he's giving. He's giving examples from that kind of size account, where, it's just Ronch, it's right above PDT. Right. And the reason that we asked him to do that and he kindly obliged is because we know that there's a lot of people out there who are, trying to implement these strategies and are in a slightly smaller, account range in that vicinity, and having an example account where the trades are being taken in that account. And, we can really kind of dig into it and show it like that. That's going to be available to members of the Trading the Post community. Then there are also people who have much larger accounts like Ronch and his other account. And there are strategies that are certainly available to them that are not available to people who have smaller accounts. And that's fine too. There's some trades that are going to go down that are just, going to be available to them. So, you kind of get the best of both worlds here in that regard. I think what you're talking about in terms of risk reward here, Ron, makes total sense. I mean, you're like in that sort of sample size account, you're talking about a loss of 300 versus a potential gain of, $3,000, or maybe if it made an even larger move, $5,000 to $6,000. Like, we'll take that. We'll take those trades all day long because we know that, in the long term, that's going to work out for us. What other trades do you feel like have gone down recently that you feel like are pretty representative of how you tend to approach positions?
So what do you want to look at? I think what I like is that we have more winners than we have losers, but when we have losers, we have ways of managing them. And I think your ability to adjust and manage a trade is what separates you from a trader that does well versus a trader that doesn't do well.
Is there another loser that you want to?
Yeah, let's look at Google.
Yeah.
Let's look at Google. Now, Google was a Google was simply a flyer, right? I rarely will play earnings. The only reason I was interested in this is we started to notice unusual option activity in Google. There was a ton of call buying. And then we didn't get word. It was publicly put out there that Nancy was buying Google. Now, what has Nancy done phenomenally well this entire 10-year run? Well, she has insider information, right? Like you saw how well she did on Nvidia. We covered that Nvidia trade, right? She was dumping stock, she was buying puts, and she knew in advance that the Biden administration was going to lower the boom on the semiconductor industry by basically shutting tier 1 and 2 tier chip availability to China, right? Like it's like the one thing that administration, and I don't want to get into politics, it's the one thing that administration has done to actually try and force another country's hand that's been trying to beat up on us. So that's some pretty significant information. So if you see that and it's Nancy, she's got insider information before the news is ever released, right? So we caught it once. We're looking to see if we can catch it again. So we find out that Nancy's buying stock on Google in front of earnings. I'm like, are you kidding me? Like this has got to be too good to be true, right? So we started to buy 60 days out on Google at the money strikes. And as the stock moved up, what we told our members was, listen, if you want to participate in this, you can. Here's how we're handling it. It is a complete flyer. The only reason I'm doing it is because Nancy's in there and I think maybe she knows something. So the sweepers start showing up. We get long, we get a move, and we got to move right to look. I mean, I can't make this shit up, right? That's the 50-day moving average. I mean, look at that. There are a lot of traders out there that say that moving averages are hindsight and that they don't work. I understand that. What I'm saying is you see this type of behavior again and again and again. So why wouldn't I pay attention to it? So when you get a move like this in front of earnings up to an area that's naturally an area where we would expect to see some type of change, regardless of whether that's an acceleration above or it reaches the area and it starts to cool off, we look for change in those spots. So what we do is we roll our strike prices up, collecting some profit, using that profit to simply buy some protection against the long position. So what happened was they had bad earnings. This was a miss. We were looking for a move higher. We were looking for, can we be sneaky and can we catch an insider and use their trading for our benefit? It didn't work. But what did work was because we had the protection, we were able to walk away from this trade break even. I think I lost $300. But I was set up to have, if this was going to be a move higher, it would have been a very big payday, but it didn't happen. So we walk away with like a $300 loss and we look for the next opportunity. But I will rarely play something going into earnings. The only reason I did is, Nancy's slick. She's slick. Right?
Yep. When it comes to skill sets to have right now in these markets, managing your risk, to me, is priority number one. So
you have to survive to get the opportunity for the next trade, because somewhere something's going to line up and eventually you are going to catch something. They don't always work, but you have to leave yourself an out. If you don't leave yourself an out, you'll get 1 or 2 shots at it, and then you got to go back to freaking slinging hamburgers or whatever the fuck you got to do to save up money to come back and try again. That's no way to live. That's brutal, right?
Yeah. Yeah. Well, let's go through one more.
Sure.
And maybe not a loser, but just another, it could be a winner, just a solid sort of example.
Do you want to look at a current trade?
Sure.
All right, let's look at Boeing.
Yeah.
Not super exciting, not super sexy. However, there's a catalyst event that's out of the way. Look at the size of the move that this thing had after its earnings. It got as high as 150. Well, 150 and change. I'm going to round 150 and as low as 132. That's a massive range for a single day in Boeing, right?
Yeah.
So I've got a catalyst event that's out of the way. I have moving averages. I have the 50-day moving average. I have the 8 crossing over the 21, signaling that there's potentially a change in direction, and these are starting to converge. So from a technical standpoint only, this could be an area where we start to see change. Which way, I don't know. So what do? I sell an iron condor. So this is an iron condor position right now. Let me look at the wings I have on it. I've got a 132, which is down here. And then I've got a 150, which puts me up here, which is basically the entire range of the candle. I've collected $1.25, and it's a 25 contract position. So what it means is if this continues to trade sideways and it expires, what I'm going to try and do is collect somewhere between 70 and 80% of that premium, and then I'll close the position. The other thing that I'm looking for is, hey, is this the beginning of a new channel? It's very early after a catalyst event, so I don't even look back here anymore. I'm looking, here's the event and what's going to happen going forward. I don't know what's going to happen, but what I do see is the potential for this to try and catch some direction. And if it doesn't, then my contracts are going to expire worthless, and I'm still going to make money on this trade.
Right. Yeah. So let's talk about what you would do if it catches direction in either way. Like, the version of it getting lucky and the version of you saying,
so we like to put there are some other things that we like to do that we like to look at so that we have an idea. So for example, if I go to FinViz and I type in Boeing, I get some stats that get put up here, right? So one of the things that I like to look for is ATR, which is average true range. In other words, how many points will the stock move in a day? So I can at least take a look and say, okay, how much has this thing moved today? Is it in its expected trading area or trading range? And let's say tomorrow it is an up day, and let's say that average true range starts to come into play. I know from 142, and let's just add, or let's just call it 143, and add $6 to it, right? That puts me at 149, right? Mm-hmm. That makes this my 150, that puts my 150 strike that I'm short in jeopardy. So what do I have to do? Well, I can panic and I can just close the whole position at a loss. Mm-hmm. I can sit there and watch the 150 until it becomes so painful that I get duped into selling it. And as soon as I do, it reaches an area of resistance and comes right back down. That happens. Or I can be proactive. And if it gets above the 50, if I have a strong day in the market, if I have other things that I'm looking at, for example, on Boeing, what else do we look at? We look at things like CCI and RSI. Are they overinflated? Are they at areas where I could see change? What else do I look at? I look at the volume profile. I look at the tape, and I start to see if there looks like there could be an opportunity for me to just go ahead and close that short leg and then buy it back to open,
Mm-hmm.
right?
Mm-hmm.
This confuses a lot of people. It takes practice, but basically what I'm doing is I'm buying back the short position and then I'm buying the same position to open. I know
Mm-hmm.
it's confusing, but
Yeah.
basically what happens is, you've got 4 legs in this position. I'm buying 1 leg back and adding to it on the other side, and I can catch direction. If I catch direction and I get a day or several days out of it, what I can do is I can turn it into what may become a longer term trade. I can turn it into a short term trade where I can get to a break even standpoint. I can take this and I can hang on to it for profit if I want. There's a lot of different things I can do with it when and if it decides to pick a direction.
Yeah. Yeah. I mean, I feel like as I'm sitting here listening to you explain this, a lot of what you're doing, most of what you're doing, you're not using super complex, highly sophisticated tools.
Correct.
The analogy that came to mind is like you can build a house with a hammer and a saw and nails and wood. You need to know you need to know how to use them, but you don't need to use anything super fancy. I think what you are so good at doing is using those tools, using those whatever it is, those indicators, those techniques in the right way, and using them in conjunction with one another in the right way, and then implementing it with a sound mind, calmly, and not freaking the fuck out.
Yep.
Yes, I think when you get into just what you were talking about at the end with some more like advanced position management of looking at your entries, you're looking at tape. Yes, tape is way more complex. We're not sitting here saying that somebody could just pick that up, in a week with you. They can hear what your read is on tape. They can hear what Lucci's read on tape is in the rooms. But outside of that, like you're not doing anything that is really that complex. The tools that you're using, it's really just about knowing when to use them, and how to use them. So it's just important to highlight that. Like I think some people when they get into the world of options, they're just like, oh my God, this the Greeks, and there's it's infinite mathematical, possibilities of what can happen. And all of a sudden you're John Nash, like writing numbers on a window, freaking out. And it's like, it doesn't actually have to be that complicated to manage your risk and be able to capture some of these upside moves. So
and it's trading, and everybody has an opinion, and oh well, you should have done this, or you should have done this, or you should be looking at it this way. It's because it's trading, and because everybody does have their own way of looking at a trade or how they would manage it. Just being able to know what levers to pull and when really is what separates. Now, this is not a flashy trade. It's not sexy. It may not work, right? But the whole thing about taking a look at this and putting the trade on is to say, okay, here's my theory. I don't know what direction this thing is going to go. I ultimately have no clue. Could it just continue to sit here and chop? Yes. Is it likely, given how Boeing moves? I don't know that it's likely that it'll stay. This is a very small channel, right? Could it stay in a larger channel? Yeah, it can stay in a larger channel, but can I get away with looking at something right now and maybe taking advantage of a small period of time where it's gonna trade sideways? And if it doesn't want to stay and I can catch it moving directionally, I already have a head start. I'm not trying to thread the needle. I'm already there. I'm already there for a move.
Right. Yeah. And Parvez just said in the chat, Raj is a master of keeping it simple, reminding everyone to calm the fuck down. Like simple trading is beautiful trading. And one thing I have definitely seen is the more, when you talk to people who are really, really good at managing money and investing and trading, and you ask them complex questions, they're able to give you simple answers, and people who are more sort of intermediate or intermediate advanced, they'll give you really complex answers. But like I was just listening to a podcast with Matt Levine, who is one of the best, journalists in finance right now. And the way that he can give you a simple answer about a very complex question shows, mastery and expertise. And I think that also extends to strategy. Ranch, we got a question here. I don't know if this is something that you can answer, there might be too much complexity, but what are, I think I'm reading this right. What are the inside numbers for that iron condor position? Like, what do you center it to? What is your criteria for those numbers?
The criteria for the numbers are, okay, so number one, you had a catalyst event, you had earnings. So you had this big move after earnings. And all I'm doing is on a chart, I'm eyeballing, well, what's going on technically? So the first thing that catches my eye is there potential based on what I see in technicals now that a catalyst event is out of the way? And my eye immediately comes to things, because this is how I'm trained, is to look for things like, oh, the 8 crossed the 21. That signals a potential, not definite, a potential change in direction. Okay, well, what does it have to fight its way through? Well, I know it has to fight its way through the 50. And I know that if it were going to make some kind of a nice move higher, I know the 200 is potentially an area of resistance as well. So if I just look at this candle, just this move, right, that Boeing had, and if you recall, I saw that we said that the ATR on it was like what, 8 or 630, like you just call it $6 or $7. So, you had like a 20 plus move on the stock. It's an outsized move. It's after earnings. Is the stock tired? And is it tired in a point where it just wants to move sideways a little bit until it catches its breath? Or is it going to puke? I don't know. But what I see here and what I know from the past experiences and how I'm trained is that you have technicals combining, looking for a reason to give this stock a move either higher or lower, right? So I don't know which way it's going to be. So if I can collect premium, and why am I using, 150? Well, because that's where it kind of topped out. And why am I using 132? Well, because that's kind of where it bottomed out. So I am playing a little game of chicken, right? I'm betting that, hey, it's not going back up here, and I'm betting it's not coming back down here.
Yeah.
That's it.
Doesn't have to be any more complex than that. Okay. I hope this is really helpful. I think we went through, we took apart a good bit of your thinking and how you're able to structure a lot of these trades and manage these trades as they unfold in a way that manages risks, but definitely gives you the opportunity to capture that upside. So if y'all are interested in learning, from Ron, from his course and being in his rooms, highly encourage you to take advantage of the discount we're offering on the Trading the Post package right now. Again, you can save $250 off that if you use coupon code TTP save 250 at checkout over at tradingthepost.com. That offer is available until tomorrow night, which is November 1st, 2022, tomorrow night at midnight. So thanks everybody for being here. Ron, thank you for doing this and breaking it down. Again, keep your eyes on the Twitter to catch FOMC, Ron live trading FOMC on Wednesday. That's always fun for people to,
that's a good day. Yeah.
Pull up a seat next to Ronch and trade alongside him. So thanks everyone for being here. Appreciate it.
Have a great day. See ya.
Y'all.